Hello, everyone. Today on the Final Bar, we'll talk about this market in a choppy, more downtrend sort of feel to the day. Defensive sectors leading with consumer staples, utilities, two of the top three, including healthcare up there as well. We're going to talk a little bit about some particular healthcare names setting up fairly well. Plenty of breakouts in that space, but also some stocks feeling some relative pain. We'll also dig into some of the sentiment indicators. What are they telling us after this choppy period? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of StockCharts, using the technical analysis toolkit to better understand investor behavior by quantifying trend, momentum, breadth, sentiment, and most importantly, price. We'll talk about the message that the markets provide back to us in the form of price. When you're looking at today's trading, you have a market in a choppy sort of sideways pattern over the last couple of days. But while yesterday finished in a position of strength with the S&P closing above 4,700, which has ended up being a meaningful level to pay attention to, today coming right back down, never really making it back up to that level and accelerating to the downside into the close. So a bit of a different feel than what we've seen. We're going to look at that overall market environment, talk about this short-term choppy period, a little more of a defensive feel to the day today with a lot of offensive sectors at the bottom of the list. But how does this relate to the long-term trend, right? And I would argue from a bottom-up perspective, there are plenty of stocks, even on a day like today, that are breaking out just fine in constructive setups. We talked about this being a rotational environment, a good environment for stock pickers. Certainly seems to be more of the same today. Here's what's coming up on the show going into next week. Today, I'm excited to talk to Samantha LaDuc from LaDuc Trading a little bit later. Next week on the 14th, we have Jonathan Krinsky from Baycrest Partners. On Wednesday, the 15th, Mish Snyder from Market Gauge. On Thursday, the 16th, Sam Stovall, who's the strategist at CFRA Research in New York. Also, a couple of quick things to let you know. The next week on Thursday, the 16th, is our latest episode of The Pitch. If you go to stockcharts.com/the pitch, you can see all of our previous episodes of that stock picking showdown, a great exercise of bringing together three strategists who all compared their own stock picks. It'll be 6 p.m. Eastern on the 16th. I will be moderating a conversation with Aaron Swanlin, T.G. Watkins from Simpler Trading, Larry Tentarelli from Blue Chip Daily. Should be a lot of fun. Please join us there. Also, a couple other things. If you go to marketmisbehavior.com/market trend, you will find information about my upcoming free event. This is coming up next Tuesday, 1 p.m. Eastern. We'll be doing a discussion on how to develop a market trend model. I'll talk in a little more detail about the market trend model I often share on this show. Usually on Friday, we'll look at the market trend model at the beginning of the conversation. We'll talk a little bit more about how that's constructed, why I came up with that combination of three timeframes, and what it can tell us about historical market cycles, but also the current market environment. If you're interested in that free event, go to marketmisbehavior.com/market trend. Finally, this is our holiday special all through the month of December. If you ever thought about joining StockCharts as a premium member, this is a really good time to do it because it's the best deal you'll get through the rest of the year. You get 2 free months basically off of a year if you join up. Also, if you renew an existing membership, you get the same deal as well. Go to stockcharts.com/special for more info on that. Let's continue on today's show with our market recap. Let's look at this choppy sideways digestion sort of period that we've been in the last couple of days and see how the short-term movements relate to the long-term. In the short term, looking just at today, the S&P closing just below 4670, down almost 0.75% from yesterday's close where we finished just above 4700. The NASDAQ really pushing lower, leading the way lower with the NASDAQ 100 down 1.7%. Mid caps and small caps struggling as well with the small cap index down 1.7%. The VIX is bouncing back higher. So yesterday got down right to around 20, bouncing back up just above 2150. So, I was asked earlier in an interview today about volatility, and my comment was, I don't see us being in a low volatility environment, given the uncertainty we have, given all the unknowns going into next year and the reality of the coronavirus, the Fed, and all these other potential catalysts for price movements. I think volatility and elevated volatility is certainly going to be more of the norm going into next year. Looking at other asset classes here very quickly, interest rates coming off. Yesterday was a bit of a rise in rates with the 10-year getting back above 1.5%, back below, but not by much, around 140, 149, we'll call it. The dollar index a little bit further in that rotation from a weaker dollar environment to a stronger dollar environment, weaker dollar in 2020, stronger dollar in 2021. Certainly, if you're looking at U.S. stocks versus non-U.S. stocks, I would say look at any ratio of that kind of thing, like SPY versus ACWI, ACWI, the All Country World Index, and look at the dollar index, the UUP or dollar sign USD, and you will see how those charts match up pretty well. It's all about the movement of the dollar. The dollar overall path of least resistance remains positive. Commodities as a whole down today, with gold and silver both down, the GLD down 0.6%, but energy related commodities, hard and soft commodities overall, for the most part, a little bit lower. And you can see the energy sector down about 0.8% today. A lot of movement in cryptocurrencies, which I could introduce most days that way, but a lot of red today, with Bitcoin breaking down back through 50,000, and gotten back above 50,000 after chopping around here, currently trading around 47,600, just above 47,500, which it broke below just a little while ago. Ethereum as well, and Ether prices have come down fairly steadily through the course of the day. 4,000, a really important level that I would be paying attention to there if you follow Ether. Let's look at a chart of the S&P 500 and look at this overall environment. So, today is this little, swing back to the downside after a gap higher. 3 good up days over the last 3 days. This is the first day of a down close through the course of the week. The world is not ending, so I wouldn't worry. I wouldn't worry too much. And during this whole period, I would tell you what the reality is. During this, the break to new all-time highs, October into November, during the 5-6% pullback, mid-November into early December, and then the bounce that we've seen reclaiming 4,700 yesterday. During that entire period, I'm finding stocks that are breaking out to new highs. I'm finding stocks that are breaking to new lows. So even though that is the story of the overall market, the stocks that make up that market, there are plenty of movements out there, and I think that's important to remember. When I talk about it being a stock picker's market, that's a lot of times it's more of a macro call. Do you want to be in equities or not? Then everything's sort of following that. I would say there's plenty of divergences from this overall market trend. There are stocks that have been more range bound that are breaking higher. There's stocks that have, been strong that are rotating lower and are not participating in this most recent uptrend. It's a really good time to work up your skills on scanning and managing chart lists to screen for opportunities around there. I was thinking when I was looking at this chart earlier this morning during my morning coffee routine, just sort of going through the overall market environment, I was just struck by this cyclical pattern of the overbought conditions and the bearish divergences. And it's not escaped me the fact that you've got a pretty clear bearish divergence in the month of November. We rotated lower. And my question is, we went from 4,750 down to 4,500. Is that enough? That's a 5% pullback after a pretty significant bearish divergence. Is that enough to alleviate those conditions? Now, at times in 2021, that has absolutely been the case. This is actually the deepest pullback after one of those bearish divergences that we've really seen. However, a lot of times you'd see that at the end of a phase, and you'd have a much more drawn out pullback period. I think, when I'm thinking of this, if you missed the show yesterday, go back and check it out on StockCharts TV and on demand, because we talked about the December, sort of the calendar play of December normally being a seasonally strong month for stocks. November, December tend to be pretty strong. January is actually missed. It's about 50-50, if not a little bit worse. So we could be sort of holding up here okay, and then January is where we start to get back some of those previous gains. That's a potential path that I think could have some probability there. Elsewhere, looking at the equity markets, let's look at the returns. I mentioned there's more of a defensive feel to the day, with consumer staples and healthcare, the only two S&P sectors that are higher. We're going to look at some healthcare names here in a minute, but on the bottom of the list, you have consumer discretionary, real estate, and technology. And two of those, tech and consumer discretionary, certainly thought of as more, growth-oriented, more offensive categories, as opposed to REITs, which are a little more defensive, a little higher income defensive plays. So, certainly defense over offense is the feel that I would attribute to the day today. Not unreasonable given the bounce that we've had after the recent pullback in recent months. So the next question is, what's the next move? And we may be settling into a range here in the month of December. That's an idea that I'm probably going to spend a little more time on here in the coming days and weeks. I want to finish off just looking at healthcare in particular, because it's one of the better sectors, one of the few sectors up today. It's interesting that the two sectors gaining ground today were consumer staples and healthcare. When I'm looking at healthcare, I'm finding a lot of charts that are sort of at that breakout point. Something like Abbott Laboratories comes to mind, right? With a nice sort of consolidation phase, this basing pattern through much of the year. And even though it's made new highs, it really hasn't followed through. All of a sudden, just starting to get above 130 for the first time and potentially holding up there. Names that are up pretty good today or bucking the negative trend. McKesson would be one of those. That's a pharmaceutical name. Really a consistent uptrend. This uptrend, or this move higher today, up about 1.8%, just the latest leg higher and a fairly consistent uptrend. CVS also on the new highs list today with a 4.5% rally. And a name like this is interesting because it pulled back to the 50-day moving average, remained right at that breakout level. So you had the May high. We broke out there in October. We've now retested that level from above and now rotating back and making a new high. So impressive relative performance, making a new 6-month high today on the new swing higher. That's the sort of chart that seems like an interesting opportunity, regardless of the macro environment, regardless of what you think about the big picture. I think it's always an interesting opportunity to look for names that have improving price and relative profiles. We need to take a quick commercial break. We'll be back with today's guest, Samantha LaDuc. We'll see you in a minute. Back to the final bar. This is Dave Keller here at StockCharts.com. So good to have you join us every weekday after the close. Pleasure to have you join us on the show. And I will share with you a couple announcements before we get to today's guest, Samantha LaDuc. First off, we love to hear your questions, particularly what you're running into as you're trying to analyze your own charts on your own platform. Send us your questions via email. That's the best way, thefinalbar@StockCharts.com. We're also on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts channel. We'll gather all of those and hope to answer one of yours on the air in our next mailbag segment on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. You can see lots of great guest appearances like Samantha LaDuc and many others, special events like The Pitch, our year-end review coming up in December, so much more. Go to StockChartsTV.com or on any of the app stores. Just search for Stock Charts TV on demand. I want to welcome on today's guest, Samantha LaDuc from LaDuc Trading. Samantha's been on the show a number of times, always does such a great job of relating the current market and helping us get a proper big picture perspective. Samantha, welcome to the show.
Thank you so much, David.
So plenty to talk about. I feel like we have hours of content we could probably go through, just given the movements and given all the conflicting themes. Let's talk about interest rates. Let's talk about the interest rate environment, because that has certainly been a key input or a key indicator looking at growth versus value. We're looking at the 20-year yield here. Start us here. What are you seeing?
Well, first, this is really timely, I think, talk, because tomorrow we have the CPI print, and it is expected to be hot. So year over year, we printed 6.2% last month, and we're expected to go up to 6.8%. Whether we again, kind of outperform on those inflation expectations or disappoint, maybe because some of the pricing has come down in used cars and housing is stabilized. But for the most part, we're really sitting right before a very important FOMC meeting, which is next Wednesday. So yes, rates are going to matter because they very much affect this duration trade of tech. So we are all, whether we like to admit it or not right now, bond traders, because we are so heavily focused on tech as our growth engine for the equities market.
It's so funny. I don't know if there's ever a time when we shouldn't be looking at the fixed income markets, but I think certain times you can get away with it, right? You can get away with not paying as much attention because you can be looking other places. But this is one of the times you were right. It's super topical, and there's so many things moving there that you have to pay attention to. You know, looking at the long-term trend in bonds, looking at the long-term trends in rates, how do you make sense of where we're at now relative to where we've been?
Well, I brought up two charts. One is of the 20-year yields and 30-year bonds, and I bring those up because the announcement next Wednesday is supposed to include, more tapering. In other words, they're pulling that forward. It's definitely on the agenda. Bill Dudley's already done, an article in Bloomberg kind of warning that the Fed officials are also likely to signal a faster and larger tightening of the monetary policy over the next 3 years. So that particular chart that I sent you of the 20-year is big picture, right? Multi-decade, going back to the 1990s. And I've kind of highlighted, hopefully, this inverse head and shoulder. We talked about this in the past, and I said this is going to be a 2022 story. So basically, we have come down right to that 1.75 and bounced, little bear steepener of late. I think that's going to continue. So obviously, rate market, place your bets. If we get back above this 2.25, we're definitely going to go into a new kind of rate regime. And I think that's what the Fed officials might be signaling at the next meeting. And if you go and look at the 30-year bond, which is the 30-year U.S. Treasury bond price over many, many decades, even back to the 1980s, you can see this very defined channel. This is on a monthly chart. But the point is we're also forming a head and shoulders potential. Right now it's neutral, neither bullish nor bearish, which is kind of seen in our everyday kind of chopping around business with the bonds. But let's see what that looks like in 2022.
It's such a great chart, and I appreciate the number of years you're showing here to really think about the long-term trend. It strikes me as you're showing these charts, Samantha, how very many investors, I would argue maybe a majority of investors now, really haven't seen a rising rate environment. We haven't been investing, and it's a totally, I certainly haven't seen one before for any extended period of time. That could be an interesting challenge for a lot of investors, I think, that are used to the opposite. Your last chart really, I think, addresses the implications of interest rates to growth versus value. Tell us about this one.
So this is a chart that I do up and look at regularly for kind of inflection points. This is, for me, it's a smoothing indicator to kind of show that growth to value and then value to growth rotation. And I've tried to kind of show at least the past few years. And back in September 4th of 2020, we had a big drop in NASDAQ in a week. It was 14%. And it kind of stuck out like a sore thumb because my indicator on the lower panel, kind of a red highlighted area, rolled over. So again, this was September 4th, 2020, and it really marked a period of outperformance by value. So energy skyrocketed to the top of the list for the fall of 2020 and in the first quarter of 2021. And then we basically, in May 12th was when I got the next trigger for a rotation from value back into growth. I remember it was my birthday. And I was very impressed that we've also done so well in this growth engine, right? Apple, look at them all. Very, very hot, way, way too hot. Look at the spike. So to me, we're on the lower panel starting to roll over. And I've been telling clients, I don't think this is going to happen until the end of the year. In other words, beginning of Q1 2022. And with that, NASDAQ has outperformed for 13 years. I think it's time for a pause, maybe even a reset.
It's been an incredible story of growth over value, so much that I think so many of us are used to that just being the story. You're implying sort of the opposite, right? A return to value, rates going a little bit higher. Interesting set of charts to think about going into next year. Samantha, listen, it is great to see you on video on the channel. So thanks for coming on again, but stay safe and be well. We'll talk to you again soon. All right.
Appreciate it. Bye-bye.
All righty. Bye now. That's Samantha LaDuc. She's the founder of LaDuc Trading and great long-term charts. Again, I'm so thankful when people come on and bring long-term charts. It's so easy to get caught up in what I call the flickering ticks, the short-term dynamics of the market, but some charts that really tell the story. And I don't know if when I'm on camera at the beginning of the show, if you ever notice the charts that are behind me in my office, but I have 4 wall-sized paper charts around me, which is, coming from my days at Fidelity where we had the chart room with all these paper charts around. But one of them is a long-term history of interest rates and looking at the long-term trajectory. We could be setting up for a very different experience in 2022 with rising rates versus the relatively low rates many of us have come very accustomed to. Let's continue on today's show with our next segment called Getting Sentimental. So a lot of the weekly sentiment data is updated Wednesday into Thursday. So Thursday shows a really good time to take a look at some of the sentiment readings, see what sort of themes we can tease out and see what sentiment can tell us about the I guess I would say, the mental state of the investors and respondents to these various surveys. So sentiment data for me has a couple different parts. Part of it is looking at the options market, right? Looking at other markets related to stocks. And the VIX is maybe one way to do that. Put call ratios would be another way, right? Looking at sentiment data, or really positioning data, I guess is what you would call it. Looking at the volatility in those areas and prices to better understand what that implies about the underlying markets, the S&P or the major averages. Second piece would be survey data, which is looking more at how people are responding, not just with how they're voting with their capital, but how they're actually, expressing their concern or their excitement about the market environment. And in this sentiment segment, we're going to touch on all of those things and a little more. Let's start looking at the VIX. This is going for the last 3 years, and volatility has been an interesting experience. If you look, 2019, 2020, 2021 have been 3 very different years if you use the VIX as a gauge of what normal is, right? 2019, normal was around 10 to 20, and that was pretty much the range of the VIX. 2020, we had this huge blowout reading in the first quarter as the market sold off. And from there, we settled in from around 20 to 40. That became the new normal. In about the second quarter of 2021, we settled into yet another range, going from 15 on the lower end to 20 to 25 on the upper end. We're potentially setting a new range up. And if you had to ask me to pick which of these years is going to look most likely going to look like 2022, or which is 2022 going to look most like 2019, 20, or 21, I'd probably have to say more like 20. I don't know about the huge sell-off and spike, although that could certainly happen, but I'm thinking more about the general elevated volatility environment that we've been in. We got very used to 2019, where it was sort of a slow and steady gain, sort of consistent movers. 2020 and 2021 have seen, a lot more volatility, elevated the VIX, more significant movements, much more of a rotational environment in 2021. I wouldn't be surprised if we have more of that type of feel with volatility that is more in the 20s and less in the teens. Again, we'll see what the market actually gives us, but it's worth remembering when you're looking at the VIX. This is not a bound indicator. Just because 15 has been the bottom so far in this year does not mean we can go much lower. Can't go much lower tomorrow. Same thing. We went, we've hit resistance around 2025. We blew that by and went to the low 30s in the last week or two. So overall, volatility spiked higher. The VIX was above 30, right back to around 20, which is sort of the midpoint of where we've been in for much of 2021, as the S&P sort of chopping around, ranging between 4,700 and 4,500. I think that's about right, that the VIX is right about mid-range for where it's been year to date. Now we're getting into some of the survey data. We'll start with the AAII survey. This is a weekly survey of individual investors. Are you bullish, bearish, or neutral on stocks for the next 6 months, is the way that it is phrased. And what's happened in recent weeks is you had the bullish reading well above 40%. I tend to think of 50% as that euphoric level. Above 50%, you want to start looking at historical times when we've been that elevated. What does that tell you? 40 to 50% is sort of a nice, strong bull market phase. We've come off quite a bit. So we were just below 50% about a month ago, maybe 5 weeks ago, and we're down below 30%. We've been around in that range for the last 3 weeks. This is the third straight week, about in that 28 to 30% bullish range. So not a lot of change in terms of the overall bullishness. What is interesting to me is the bearish reading that went from about 42% bears last week to around 31% bears this week. So 10% of people basically went from bearish to neutral on this week. So what that tells you is, with the S&P pulling back, a lot of people got bared up. The most bearish reading we had since last October, last September. All of a sudden this week it turns right around, given the bounce higher in stocks. A lot of investors taking their foot off of the bearish argument and going back to the relative safety of the neutral reading. What's interesting right now is, as of this week, pretty even, right? If you look, it's about 30% bulls, 30% bears. If you're looking for an indication of indecision, that might be one of them that I would agree with. This is a market really in search of the next move, not deciding already what the next move is. Another interesting change in a sentiment indicator is the name exposure index. So if the AAII survey is a measure of individual investors, this is more active money managers. So professional money managers, and they're asked, what's your exposure to equities? 100, 200% long, 0%, 100%, 200% short. And you can respond in one of those ways. couple of weeks ago, this is up above 100%. Had about a 6-week stretch of being over 100%, meaning over long, net leveraged long, right? Over 100% allocated to equities. Last week, it was just around 80, 85, 90% almost, if I remember, about 88%. This week, it's almost 20% lower. It's just below 70%, coming in around 69.50. So what's happened is in the last couple of weeks, you've literally had a huge swing away from leveraged long to way more defensive, or really way less allocated to equity. So the last 2 weeks, a lot of money managers, this is telling me, is rotating from a long or leveraged long position to a long and or flat position, or a much lighter weight to it. And as a result, what tends to happen at a major turning point is you get the anecdotal evidence. The smart money kind of gets out and rotates out of the market. Then that's the first move down. The next leg down is that big long third wave is when the masses sort of recognize the weakness in stocks and start to get out here. So this is a really interesting indicator, really interesting survey to look at through the remainder of this year into the beginning of the next year. Thinking about what Samantha LaDuc had mentioned about rising rates, about the potential for some disruption based on that different environment. Are money managers becoming less and less bulled up in their positioning? Last chart I want to show you is just the put call ratio. We only have a minute for this. Just want to highlight the fact that the put call ratio, both with the total put call ratio and the equity put call ratio, one of the highest readings that we've seen. This is actually the highest reading this week in 2021, just over a value of 1 for that put call ratio. It's pulled back just a little bit, but overall fairly elevated. And this is the moving average that we're looking at in pink, by the way. So you had a spike higher and it's come off a little bit. In pink is the 5-bar moving average. So I'm basically just smoothing out the data to get rid of some of the noise. And it's worth noting that that average reading is the highest it's been since April of 2020. So it tells you that put call ratio has spiked quite a bit. That tends to coincide with market bottoms after steeper pullbacks. That's what I'll be watching this one going forward as well. We need to wrap the show. Go to the 3 in 3 charts in 3 minutes. Here we go. Chart number 1 is the VIX. We had a segment, Getting Sentimental. We're focusing on sentiment indicators. We spent a good amount of time on the VIX. I actually put a video on my YouTube channel last week, particularly on the VIX. If you go to Market Misbehavior, the channel on YouTube, you will see that one. And overall, we talked about just this volatility environment and what a spike in volatility tends to mean relative to other indicators. And the VIX going above 20 historically in 2021 after the first quarter has been a pretty viable pullback. And the problem I have with that general thesis is that works until it doesn't. The problem with a viable dip is the beginning of a steep downtrend looks like a very viable dip. So you have to make sure that you're managing your risk effectively. So as we're looking at the S&P now range bound between 4,500 and 4,700, my question is, which way do we resolve? And I'd be eyeing that 4,500 level for sure. Chart number 2 is biotech. I'd mentioned something about cruise lines on the show yesterday or Tuesday, I forget which day, but highlighted some of those bouncing off of oversold levels. And someone remarked that looked kind of like the biotech chart, which I agree. We're looking at the XBI there here, which is the S&P Biotech ETF. A beautiful exercise in Fibonacci analysis. If you take the March 2020 low, take the February 2021 high, you can see we have bounced just beautifully off a number of these Fibonacci levels. We bounced off the 38.2% level a number of times, then the 50% level through much of 2021. We found resistance often, or the uptrend would be exhausted around that 38.2% level. We've now come down to that final Fibonacci support level, which means more often than not, you'd expect support, especially as we become oversold right when we get there. The question, though, is that the beginning of something more, more stronger? Is it the beginning? Is it the bottom before we rotate higher? So here's how I would think about it. Remember, this is a chart making lower lows. This is a chart making lower highs, and it's a chart below 2 downward sloping moving averages and making new 12-month relative lows. For me personally, that is not the type of chart I enjoy. I look for some signs of accumulation, but there are signs of strength even in biotech and definitely in healthcare. I highlighted some of them earlier in the show. Regeneron setting up with a huge cup and handle pattern, breaking above 680. Could certainly validate that. Folks, that is our show for today. Thank you so much for joining us every weekday after the close. Special thank you to Samantha LaDuc from LaDuc Trading, joining us and sharing her thoughts on interest rates. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.